Are the high yields of closed-end funds for suckers? Wait, what? What is a closed-end fund, also known as a CEF? Moreover, should you even care? Well, Adam Aloisi is back on the show to explain what CEFs are and how to find value among them. This will also include his thoughts on the ever-dangerous, quote-unquote, sucker yield that could be a problem for many CEFs out there today. Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we want to make the best investments that we can. So thank you so much for joining us. Remember, our goal is to help you learn to invest financially and in all of life. You can always find more at investinthefamily.com and subscribe to the podcast at iTunes and the Google Play Store. As always, we're offering a newer feature to the show where if you want my detailed notes from today's show, perhaps you're not able to take notes yourself or just want to have them straight from me, maybe you missed something or want to have something remembered later on from the show, simply text the word Family Notes, that's one word, Family Notes, to 44222, or simply go to investinthefamily.com and sign up for the email list there, and we'll be sure to send you a link to those notes as well. Do you like shopping for insurance? Of course you don't. It can be a terrible experience, especially when it comes to life insurance. But if you have loved ones that you want to take care of financially after you're gone, then you may want to consider term life insurance, and Policy Genius is the easiest way to get insurance, period. At Policy Genius, you can figure out what you need, compare the top policies, get covered, and save. If you want to save on term life insurance, go to investinthefamily.com/policygenius. That's investinthefamily.com/policygenius for access created specifically for Investor in the Family listeners. I do get a small commission if you use my link, which costs you nothing. It's a win-win. Visit investinthefamily.com/policygenius for more info and have the most enjoyable insurance shopping experience you've ever had. And I hope you enjoyed today's interview with Adam Aloisi. Well, hey, Adam, welcome back to the show.
Nice to be here again, Brian. Thanks for having me.
Absolutely. Like I said, always a pleasure to have you on the show. Recently, we just spent some time talking about dividend stocks and whether or not they're overvalued as a whole or if they're in a good place for investors. But you've also written recently about closed-end funds and as far as whether or not the high yields are sucking in investors and whether or not investors can actually offset the rate risk with target term bond funds and different things like that. And I'd love to hear the thesis of some of those recent articles on CEF investing, closed-end fund investing, and kind of get a feel for where you're coming from.
All right, Brian. So CEFs, closed-end funds, for those who do not know, are kind of this very small niche of the investing world. They're similar to ETFs in that they have a basket of underlying holdings. Closed-end funds, as opposed to exchange-traded funds, have a limited number of shares available, so they will actually trade on what's considered a discount or a premium to market, as opposed to ETFs, which traditionally trade right around market. So one of the benefits of CEFs is that most of them, I think it's about 80% nowadays, will leverage themselves, which means that they will borrow extra money to get a higher yield than maybe an ETF that's practicing the same strategy. So in this ZIRP era, just like everything else where investors are struggling to find quality yield, CEFs have gotten a bit of attention. And so just like everything else nowadays, you should be considering whether, there is a value in CEFs or whether you're looking at a yield that's unsustainable, not really real, or extraordinarily risky. So, I took a look at, the CEF space as a whole, and kind of authored an opinion as to whether these are appropriate products for investors to get into or not. And the somewhat middle of the road answer is maybe, because you have closed-end funds that have good performance histories, have reasonable operating expenses and competent managements, where you probably are, in a good position to get a incrementally higher yield than you might in an ETF going forward. You also have CEFs that are paying out more than what they're actually bringing in. That gets into a complicated issue of return of capital and undistributed net income, which is part of the CEF animal. As I noted, this is a rather complex instrument, all things considered. So unfortunately, my answer is, maybe you should get into them, maybe you should not. But just like everything else, you need to understand what the risks are with a CEF, and there are, there's a larger number of risks to consider when you look at a CEF relative to a ETF or an individual bond or an individual stock.
So someone might have a closed-ended fund, a CEF, like maybe that tracks the S&P 500, for example, kind of like SPY, or maybe one that will track certain kinds of commodities. And then, but because they have a limited number of shares, they could trade at a premium or a discount. And for that reason, what does the leveraging look like? How do you leverage a fund like that?
Well, just like somebody who goes out and, wants to buy a house, they'll go get a loan from a bank. The CEF is going to go borrow money, and they can do it in any number of ways, but they will get a tremendously low interest rate on that loan usually. So, the spread between what they earn on those borrowed monies versus what they are paying to borrow the money could be your incremental return advantage versus a investment where there is no leverage. Of course, that's the positive side. The negative side is if the strategy is not working for whatever reason, interest rates are going up and bond prices are going down, or the stock market as a whole is going down. If you're in a equity type closed-end fund, your downside will be magnified. It depends on the fund and what the strategy is specifically as to what that downside might be. But that's one thing you need to consider. And also, you mentioned in the first part of your question about index funds and so forth. The CEF is generally looked at as an income vehicle, and even funds that are heavily weighted with equities will tend to have some type of income overlay strategy in them. Income overlay meaning a option income strategy, selling calls is typically what those funds will do. So you could be, there's a group of index funds from the Nuveen closed-end family that tracks the S&P 500, the NASDAQ 100, as well as the Dow Jones Industrials. And they yield, all three of them, in the 7% range right now. And obviously, if you look at SPY, I think the yield is probably in the 2% range right now. So when you're looking at a closed-end fund yielding 7%, they're not just investing in the index. They're investing in something else on top of the index. So they're selling calls on the underlying holdings or on the S&P 500 itself, depending upon the strategy. So it's important that, you don't just go and look at a CEF and look at the yield and say, oh my gosh, that's wonderful, I'm going to invest in it. You need to understand why the yield is there. You should also make some attempt to understand whether the yield is actually being covered by organically generated income as opposed to just giving your money back on an occasional basis, which would be that return of capital issue that I talked about earlier. So there's a lot of things to weigh here. If you're looking for pure growth, it's possible that going to an ETF may be the sounder route than going to a CEF. Because as I mentioned, they're looking for income. And when you have a covered call strategy, your upside is going to be limited, generally speaking, compared to a fund that doesn't have a covered call strategy, because the stocks will generally have an upside limit to a point where they will be called away, creating portfolio churn. On the other hand, if the market is going down a little bit, a closed-end fund with an options overlay will actually help you to total return-wise if the market actually turns down on you. So
just to try to understand the CEF well, so you've got you basically have an organization, like some company who, like you mentioned, the Naveen closed-end family as an example. So you have this company who has a number of funds, and they're taking capital they have from investors, and they're investing that capital just for simplicity's sake, a fund that would mirror the S&P 500. But they're not just doing that. They may borrow some money at really low rates, and they can leverage that, meaning they can invest borrowed money into that fund as well to kind of help boost the yield or boost the return and growth a little bit. They could also buy or sell options with some of that extra money around those companies in the fund to help boost yield as well. Is that basically what's going on? Is that accurate?
Yeah, I would say that that's a good bird's eye view of it. I don't think the option income funds typically leverage a lot.
Okay.
When you have a strict bond fund, like a high yield bond fund, you will find that the leverage may be pretty high, somewhere maybe perhaps in the 25 to 40% range on top of normal assets. So, trying to determine where the risk is and how much it is relative to another investment is somewhat difficult to quantify. I think we can say that anytime you borrow to try to magnify an investment strategy, that you're taking incremental risk. Although if you do it with a very safe underlying strategy, say you're investing in investment grade bonds, for instance, high grade bonds where there's very little credit risk, and you leverage that, somebody could arguably say, well, that's a safer strategy than investing in junk bonds with severely low credit in this, the B or the triple C range. So, again, it's one of these things where you have to kind of judge the risk on your own and know yourself as to what type of risks you should be taking with your money.
Well, tell me this: as you were diving into CEF funds or closed-end funds, I should say, did you find any opportunities that you were excited about, or you feel like are worth looking into?
You're talking about today or yesteryear or what?
Well, when you wrote the articles a few weeks ago.
Oh, yeah. Today. Well, I wrote these within the past month. Now, I also wrote an article, kind of a flurry of closed-end articles maybe 6 months ago, end of 2015, beginning of 2016, where I looked at the space. In many areas, the discounts 6 months ago were much steeper than they were today. So I was heavily encouraging of investors to take a look at, especially the bond funds that were in some cases selling close to 20% discounts. So you were getting 80%, or you were getting 80 cents on the dollar here for the assets you were purchasing. Which is an attractive thing because you're basically able to magnify the yield by 20%. If you have a fund that's organically generating 5% of income and you buy it at a 20% discount, your yield actually becomes 6% as opposed to 5%. Those discounts have narrowed over the past 6 months or so, until where we are now, where I don't think closed-end funds are quite as attractive as were. And there's a number of reasons for this. One, interest rates, even though the Fed raised rates in December, the bond market has seen a drop from about 2.25% when the Fed increased rates to, when we had Brexit, I think we were, in the 1.5 range. We're probably at about 1.7 today, I believe. So interest rates or bond yields have actually dropped precipitously, which actually benefits bond funds. The value of the bonds held in the fund are rising. Then you have the discount narrowing. So investors in closed-end bond funds who owned them probably 6 to 9 months ago or bought at that time have done very well with, depending upon the composition of the fund, we're looking at potentially 20% returns in a year where the stock market's been very volatile and is probably not going to return nearly as much. So the general statement on today with closed-end funds is that, I think there's still merit there, but once again, we have this kind of overriding risk that interest rates will rise, which is negative to specifically bond funds, and also that discounts have been narrowing, which makes them not quite as attractive as to where they were when the discounts were higher.
So it sounds like we're back in a situation kind of like with dividend stocks and most other asset classes of nothing looks great, but you still have capital to do something with, So do you stay? Because as a overall, there's nothing that's really exciting to invest in, but there may be individual opportunities throughout, of course.
Yeah, I think that's a fair statement. It's kind of the seeing the trees through the forest deal, where you can kind of arbitrarily say that things don't look good on a whole. However, if you're willing to drill down and do some individual specific research, you might find some value. And because of this premium discount anomaly that occurs in the closed-end fund space, you have situations where if somebody's trying to get out of a fund for whatever reason, and there's many reasons to sell, you could have discounts that come out rather quickly. You may have a fund trading near net asset value, and if somebody is trading a lot of shares to get out, you could have a 10% discount open up for really no reason at all. Which would, in my opinion, even for traders, closed-end funds could be a space for traders to get involved in, even though, you're looking typically at income investors because of this. And you could have an income investor say, I'm going to become a trader because of this, because if I can buy a discount of 10%, and then that, for whatever reason, that narrows again back to net asset value, I can make a 10% return very quickly. Now, that doesn't happen all the time, and probably rarely happens. So, don't think that you're going to wake up Monday morning and go trading and say, well, I'm going to find I can go look for anything that has a 10% discount, and it's going to narrow. Some discounts just stay where they are all the time because the fund is miserably managed, the return hasn't been good, the fees are high. There's any number of reasons that closed-end funds might trade at a discount.
One last question, and I'm not sure if this is a simple or really complex one. Is it obvious when a CEF is trading at a discount or a premium? Is that something that you can look into the financials or the annual reports pretty quickly and discover, or does it take a fair amount of math and computing to figure out and get to those numbers?
Well, closed-end funds trade daily. They're traded on the market, so you know what the market price is at all times. And then they typically will post a net asset value on a daily basis after the close of trading. So there's various websites out there that track closed-end funds exclusively. One that I use frequently is called CEFconnect.com. It's sponsored by Nuveen, but it covers virtually the entire closed fund universe, and you can typically find what the premium discount situation is on a daily basis through that website. So the interesting thing about it is they have to specify these things, and you kind of know where you are. Now, when you get into bonds and some assets where there can be a lot of mark-to-market variability, meaning that they value the bond at a certain level, but whether they can actually sell it at that level or not on any given day may be somewhat up for question. So you have to have some trust in the valuation methodology that the assets are based on. But the information is out there, and you can see what your yield will be, and compare that to what you would have with ETFs or other CEFs to determine whether there's value there or not. Now, keep in mind, again, that there's a lot of things that go into this, and just looking at the yield alone may not be appropriate, and you may not be getting an organically generated yield by what is stated. You need to go in and look, does that include capital gains distributions? Does that include taxable or return of capital, which actually is not taxable? Does it include these things that are not really reflective of the underlying holdings of the fund?
Awesome. Well, Adam, it's always great to have you on the show, and I appreciate your time with us this afternoon.
All right, Brian. Great to be here again.
Well, I hope you enjoyed today's interview with Adam Aloisi. Remember, you can get full show notes with links and other details at investorinthefamily.com. Don't forget to subscribe at iTunes, Stitcher, or the Google Play Store. And if you want to receive my summary sheet highlights from today's show, simply text the one word, family notes to the number 44222 or visit investorinthefamily.com and sign up, and we'll make sure to get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.